Hello everyone. This video analyzes a federal document explaining why the interest rate should be decreased. Governor Christopher J. Waller's statement is interpreted. You will find the link in the description to the Federal Reserve page and the original document. Analysis. Federal Reserve Governor's dissenting view on monetary policy. Executive summary. A Federal Reserve Governor dissented from the majority FOMC decision, advocating for a 25 basis point rate cut based on economic data suggesting that monetary policy should move closer to a neutral stance rather than maintaining its current restrictive position. The governor's dissenting statement, context, and background. At the most recent Federal Open Market Committee (FOMC) meeting, a governor broke from consensus, arguing that a 25 basis point rate cut would have been the appropriate policy action. This dissent reflects a fundamental disagreement about how to interpret current economic conditions and manage policy risks in an environment of tariff uncertainty. Three-pillar framework. The governor's core arguments. Pillar 1. Tariff effects are temporary price level adjustments. The governor's position. Tariffs represent one-off increases in the price level, not sustained inflation. Standard central banking practice is to look through such price level effects. This approach is appropriate as long as inflation expectations remain anchored, which they currently are. Economic rationale. Tariffs function as import taxes that directly increase the cost of affected goods. Unlike demand-driven inflation or wage price spirals, tariff effects are typically one-time adjustments that don't create ongoing inflationary momentum. Pillar 2. Economic conditions warrant neutral, not restrictive policy. Current economic indicators, GDP growth, 1.2% in H1 2025, expected to remain soft. Unemployment rate, 4.1%, near the committee's longer-run estimate. Inflation, just slightly above 2% target, excluding tariff effects. Policy rate, 4.25 to 4.50%, which is 1.25 to 1.50 percentage points above the estimated neutral rate of 3%. The governor's analysis. The combination of below-trend growth, unemployment at target levels, and inflation near the Fed's objective suggests the economy is operating close to its long-run sustainable path. Pillar 3. Labor market shows underlying weakness despite surface stability. Surface-level indicators versus underlying trends. While the 4.1% unemployment rate appears stable and appropriate, the governor highlights concerns about underlying developments. Private sector payroll growth, near stall speed at approximately 65,000 jobs per month. Expected data revisions. Historical patterns suggest that current employment data may be revised downward. The governor's warning. When labor markets turn, they often turn fast. This observation reflects the well-documented tendency for employment conditions to deteriorate rapidly once weakening begins. Risk assessment. Wait and see versus proactive adjustment. The FOMC majority's wait-and-see approach. Rationale. Need to assess the full impact of tariffs on inflation. Uncertainty about the magnitude and persistence of price effects. Cautious approach to avoid premature policy easing. Desire to gather more comprehensive data before making adjustments. The governor's critique of wait-and-see. Core concerns. Timing risk. Labor market deterioration can occur rapidly, potentially outpacing policy response capabilities. Information limitations. Clarity on tariff levels and economic impacts may not emerge for several months. Policy lag effects. Monetary policy operates with significant lags, making early action more effective than a delayed response. Quantitative analysis of key economic relationships. Policy rate versus neutral rate gap. Current situation. Policy rate 4.25 to 4.50%. Estimated neutral rate 3.0%. Gap 1.25 to 1.50 percentage points. Historical perspective. This gap represents a significant degree of monetary restraint. In economic environments where growth is below trend and inflation is near target, such restrictive positioning typically indicates concerns about overheating or a policy stance that hasn't adjusted to changing conditions. GDP growth and long-run potential. Growth trajectory analysis. H1 2025. Growth 1.2% annualized. FOMC long-run growth estimate, approximately 2.5%. Gap, 1.3 percentage points below potential. Inflation decomposition, core versus tariff effects. Core inflation, approximately 2.1%. Tariff-related price increases, approximately 0.3%. Total inflation, approximately 2.4%. Risk management framework, the governor's risk assessment, downside risks, high probability, high impact. Labor market deterioration is accelerating faster than policy can respond. Economic growth falling further below potential. Upside risks, lower probability, manageable impact. Tariff effects proving more persistent than expected. Inflation expectations have become unanchored. Alternative scenarios and policy paths. Scenario 1, governor's preferred path. Immediate action, 25 basis point cut to move toward neutral. Continued assessment, monitor data for tariff impacts and labor market developments. Flexible response, additional cuts. If economic weakness persists, pause if inflation surprises emerge. Scenario 2, FOMC majority path. Hold current rates. Maintain 4.25% to 4.50% range. Comparative international perspective. The governor's approach aligns with standard central bank practices internationally, where temporary supply-side price shocks are typically accommodated rather than offset through monetary tightening. Technical considerations. Data reliability and revisions. The governor's emphasis on expected data revisions reflects a sophisticated understanding of economic statistics. Initial employment reports are frequently revised, often showing weaker underlying trends. Policy transmission mechanisms. The governor's argument implicitly relies on standard monetary transmission channels. Lower policy rates reduce borrowing costs, improved financial conditions, support business investment and consumer spending. Conclusion: balancing prudence and precaution. The governor's dissent represents a well-reasoned alternative to the FOMC majority's cautious approach. Strengths of the governor's position: data-driven analysis, risk management focus, flexible framework. Analytical assessment. The quantitative evidence provides substantial support for several key elements of the governor's argument. GDP growth of 1.2% falls meaningfully short of long-run potential. Unemployment sits at target levels, and core inflation remains close to the Fed's objective. The governor's framework offers a compelling balance of prudent risk management and policy flexibility, supported by solid analytical foundations and consistent with established central banking principles for handling temporary supply-side price disturbances. Thank you for watching. Subscribe and share.